Once again, good evening. Our tonight lecture shall be on our lecture tonight. We are looking at success of finance tonight. Our last class, we concluded on capital structure. Precisely tonight, we are looking at success of finance. To appreciate the significance of this topic, to appreciate the significance of this topic, let us look at the definition of strategic financial management. At my first class, we define financial management as an integral part of management. At our first class, we define financial management as an integral part of management that is concerned with how companies source finance and how companies utilize finance so as to meet the objective of a business entity. Now look at that definition. Financial management is an integral part of companies' management that is concerned with how companies source finance. Underline, sources of finance. That means this topic, source of finance, is the foundation of strategic financial management. If you have noticed, or if you have reviewed past questions, almost every diet, examiner will take at least 20 mass questions from this topic. Diet in, diet out. One question will be texted from this topic. We try to ask ourselves, why is ICANN so particular about this topic? It is from the definition of financial management. The whole concept of financial management is the ability to source finance, then utilize the finance to meet the objective of a business entity. Our tonight topic is, how do companies source finance? I want to explain that. We now move to the topics. The first point is that sources of finance is an important aspect of financial management. Sources of finance is an integral part of financial management. Companies must identify the various sources of finance available. Generally, finance success can be categorized into two. We have equity financing and debt financing. Generally, finance success can be categorized into two. We have equity financing and we have debt financing. You can also classify financing into long-term financing or short-term financing. If you pick a company's statement of financial position to look at the company capital structure, the company will be financed by different capital. You have equity capital, preference share capital, debt capital. You have long-term debt, short-term debt. Companies utilize variety of finance success. You can ask yourself, why is it that companies utilizing variety of finance success? Why not stick to one? If you pick a company financial statements and you look at the company capital structure, you are going to see different finance success. The question is, why is company utilizing variety of finance success? The aim or the purpose is to achieve an efficient capital structure. Companies utilize variety of finance success. The aim is to be able to achieve an efficient capital structure. We can now pause and ask ourselves, what is an efficient capital structure? If the argument is companies are using variety of finance success because the company wants to achieve an efficient capital structure, you can pause to ask yourself, what is an efficient capital structure? At what point do we say this company has achieved an efficient capital structure? There are three things to watch out for, or there are three criteria that qualify a capital structure to be regarded as an efficient capital structure. One, an efficient capital structure must provide for a suitable balance between long-term and short-term finance. One, an efficient capital structure should provide a suitable balance between short-term funds and long-term funds. Two, an efficient capital structure should provide adequate working capital. And three, an efficient capital structure should provide a satisfactory balance between equity capital and debt capital. I want to explain this. We said finance success can be categorized into two: equity financing and debt financing. Our equity finance refers to finance or money contributed to the business by the owners of the business. Excuse me, please. Our equity finance refers to money contributed to the business by the owners of the business. Who are the owners of the business? These are the shareholders. Any money contributed to the business by the shareholders will be categorized as equity finance. Debt finance. Debt finance refers to all forms of borrowings. Any money coming to the business that is not coming from the shareholders will be categorized as debt financing. Debt finance refers to all forms of borrowings. Once a company borrows money, then that finance will be regarded as what? Debt finance. Our debt finance can be subdivided into two. We have short-term debt finance and long-term debt finance. Our debt finance can be subdivided into two. You can have short-term debt finance, and you can have long-term debt finance. Under the short-term debt finance, we have bank overdrafts. Of course, we know bank overdraft, where a customer is allowed to overdraw his account, where a customer is allowed to take an amount above his current available balance. Overdraft. That means company can arrange overdraft facility to finance its need. Company can negotiate overdraft facility with a bank, which set a limit to the amount of overdraft that is allowed. You can take overdraft. Of course, it will be very rare for an examiner to ask you what is bank overdraft. It will be very, very rare to say define bank overdraft. But what are the things which you watch out for? What are the key characteristics of bank overdraft? Please note these 3 points with overdraft. The following points should be noted with overdraft facility. From the viewpoint of the bank, overdraft should be used to finance short-term cash deposits, cash deficits. From the viewpoint of the bank, overdraft facility should be used to finance short-term cash deficit from operational activities. Please note, you cannot use overdraft to finance long-term projects. Overdraft is used for short-term operational needs. That is point number one. Point number two, the overdraft bank balance should fluctuate regularly between the deficit position and the surplus position. Point number two, the overdraft bank balance should fluctuate regularly between the deficit position and the surplus position. This implies that the overdraft bank balance should not be kept at a permanent position. Then point number three, the bank normally has the right to call in an overdraft at any time. The bank reserves the right to call in overdraft at any time. What it means is that there is no specific repayment period for overdraft. Bank can tell the customer to pay overdraft immediately, and the customer must comply. Please look at those 3 points very well. If you look at the last point, overdraft facility is a risky source of financing. It's a risky source of what financing. If a company should take overdraft, bank has the right to tell the company to pay back immediately. That is settled. Number two, under short-term debt financing, we have bank loan. Short-term bank loan. Short-term bank loan might be arranged for a specific business purpose. Company can arrange short-term bank loan for a specific business purpose. But please note, unlike overdraft facility, a bank loan is for a specific repayment period. And there's usually a repayment schedule. The bottom line is companies can adopt short-term bank borrowing to finance their business. Number three, we have trade credits. Company can negotiate a trade credit with suppliers of raw material. You can negotiate trade credits with suppliers of raw material. The trade credit will allow you to buy goods on credit, and you can make payment at a later date. That means you have access financing. You can approach your suppliers to give you raw material on credit, trade credits. Of course, trade credit is at no cost. Number four, we have debt factoring. debt factoring. Companies that use debt factor to collect their trade receivables might obtain financing for most of the trade receivables from the factor. We said companies that use the service of trade factor to collect their trade receivables can obtain financing for most of the trade receivables from the debt factor. The question is, who is a factor? First, a factor is an individual or business organization that takes responsibility to collect trade receivables on behalf of the clients. A factor is an individual or a business entity that undertakes the responsibility to collect trade receivables on behalf of his clients. One of the services rendered by a factor, is that they can provide upfront up to 70% or 80% of the trade receivables they are expected to collect. That means company can adopt debt factoring as a source of finance. Let us illustrate this briefly. We know Dangote very well. Dangote is an household name in the manufacturing sector. Dangote has a lot of distributors that buy goods on credits and make payments at a later date. Now let's assume Dangote has made a sales to a particular distributor. Dangote sold goods that worth 500 million to a particular distributor. And the customer is expected to pay back in 6 months. The customer is expected to pay back in 6 months. That means in the book of Dangote, this will be recorded as sales. Now, our sales book, we are now going to have trade receivables under our current assets. Sales made, but cash has not been collected. That will now represent trade receivables to be collected in 6 months' time. Dangote can decide to outsource this collection to a factor. The Dangote PSC, Dangote company core business is to manufacture and make sales. The core business of Dangote is to manufacture and make sales. Along the process, trade receivables has occurred. The company can decide to engage the service of a factor. The factor will now collect the trade receivables on behalf of his clients, in this case, Dangote PLC. Now, one of the services rendered by the factor is that he can provide this 500 million upfront. The factor is supposed to collect the money in 6 months. The factor can provide his money, part of this money, upfront to the company. That means instead of waiting for 6 months, the factor can provide up to 80% of the money. That is like 400 million immediately to support the company's finance. Technically, the company has accessed finance by utilizing debt factoring. The company can obtain finance. Is that clear, please? And the last point here is operating leaks. In some cases, operating lease might be used as an alternative to obtain short-term finance. In some cases, company can adopt operating lease as an alternative to obtaining short-term debt finance. Operating lease is similar to rental agreements. Operating lease is similar to rental agreements for the use of non-current assets, usually for a short period, between the lessee and the lessor. Operating lease is a rental agreement to obtain the use of non-current assets, usually for a short period, between the lessee and the lessor. The lessee is the user of the property. And the lessor is the owner. If a company obtains the use of non-current assets through operating lease, the company can avoid the purchase of that asset. The company will avoid the need to purchase the assets and to finance the purchases with capital. Instead of buying the assets and go to borrow money to buy the assets, you can go into operating lease. You only need to pay lease rental. In other words, we can adopt operating lease as a means of finance. All the 5 we have explained: bank overdraft, short-term bank loans, trade credits, debt factoring, operating lease. These 5 are categorized as short-term debt finance. Any question? We now move to long-term debt finance. Let me discuss long-term debt first. Any question, please? All right. Our long-term debt finance, of course, these are debt finance for a longer term period. We can further subdivide long-term debt finance into two. We can further subdivide long-term debt finance into two. We have marketable debt securities. We have marketable debt securities, and we have non-marketable debt securities. When we say marketable debt securities, these are debt instruments that are traded or tradable in the capital markets. These are long-term debt instruments that are tradable or traded in the capital market. This debt could be redeemable or irredeemable debt or convertible debt. This long-term debt could be redeemable debt or irredeemable debt or convertible debt. Redeemable debt. These are long-term debt finance with a specific repayment period. Redeemable debt. These are long-term debt instruments. These are long-term debt instruments with a specific repayment period. Number two, irredeemable debt. These are long-term debt instruments without a specific repayment date. Then the last one is the convertible debt. Convertible debt. These are long-term debt instruments that allows the debt holders the rights, but not the obligation, to convert the debt to a specified quantity of ordinary shares. Convertible debt. These are long-term debt instruments that allows the debt holder the rights, but not the obligation, to convert the debt to ordinary shares within a specified period. Once this right is exercised, the debt will be converted to ordinary shares. and the borrower will not repay the principal amounts. Under our marketable debt security, we have bond, we have debentures, we have loan stock, we have loan notes. Under our marketable debt securities, debt instruments that are marketable, that are tradable, we have bond, we have debentures, we have loan stock, we have loan notes. Please note, all these instruments perform the same function. They are all debt instruments that can be used to borrow money for a longer term period. You can have redeemable bond or redeemable debentures, redeemable loan stock or loan notes. You can have convertible bond, convertible debentures, convertible loan notes. They perform the same function. Excuse me, please. Now let's look at non-marketable debt. Non-marketable debt. Our non-marketable debts, these are debts that are not traded, not tradable at the capital markets. A good example is long-term bank loan. Bank loan is not a marketable security. What it means is that whoever borrows money must pay the loan back. You cannot transfer that loan to another person because that loan is not marketable. The bottom line is company can adopt long-term bank loan to source finance. Company can adopt marketable securities such as bond, debentures, loan stock, loan notes to source finance. Now, what are the characteristics of debt financing? What are the characteristics of debt financing? Please note these four. When it comes to debt financing, whether short-term debts, whether long-term debts, this characteristic is likely to apply. One is interest cost. Debt finance comes with interest elements. If you are borrowing money, you are going to pay interest. Debt finance comes with interest cost. That is point one. Point number two, the interest payable on debt. The interest payable on debt is allowable for tax purposes. That means if a company obtains debt finance, The company will pay interest. That interest will enjoy tax relief. The interest will enjoy tax relief. That tax relief can be used to reduce the cost of capital of the company. What it means is that debt finance is a cheaper source of financing because the tax relief will reduce the cost of debt. So debt financing is cheaper. That's point number 2. Note, point number 3, the debt may be secured or unsecured. Or unsecured debt finance. When you say secure debt, it means that the debt is secured on the company's assets. The debt finance may be secured against the assets of the borrower. A debt finance may be secured against the assets of the borrower. Where a debt is secured, it means that the lender has the right to seek repayment of the outstanding debt out of the secured assets. Where a debt is secured, the lender has the right to seek repayment of any outstanding debt out of the secured assets in the event that the borrower fails to make payments. In the event that the borrower fails to pay the interest elements and the principal. The secured debt or the secured assets provide an alternative source of repayment. So if a company is trying to borrow money, you need to ask yourself, do you have sufficient non-current assets that you can use as collateral for the loan? They are unsecured debts. For unsecured debts, the lender does not have the second source of repayments, no alternative source of repayments. If the borrower fails to pay the principal amounts and the interest elements. We have explained 3 things in relation to debt financing: interest cost, tax relief, secured debt and unsecured debt. Then the next explanation to round up on debt finance is what we call committed funds and uncommitted funds. Please, as much as possible, try to get the concept here. Committed funds and uncommitted funds. As much as possible, try to get the concept here. committed funds. Most debt finance is committed funds. Most debt finance is committed. What does that mean? It means that the lender is committed. The lender is committed to provide the finance to the borrower over agreed maturity period. The lender is committed to provide the finance to the borrower over agreed maturity period. And the borrower is not at any risk. The borrower is not at any risk that the lender will demand immediate before maturity. As information that is very salient. This network now started to go off. Please, in addition to whichever textbook you are using, if you are using textbook, do not leave out ICANN study pack. That study pack is detailed and will help you a lot. All right, let's go on. Let me illustrate that briefly. Our company XYZ PSC. We approach First Bank to obtain loan. We want to obtain a loan of 500 million from First Bank. And we are supposed to pay back in 5 years' time. In this case, our company XYZ is the borrower, while First Bank is the lender. Under committed funds, the lender is committed to provide finance to the borrower. That means First Bank will provide 500 million to the borrower XYZ PSC for 5 years over agreed period. And the borrower is not at any risk. The borrower is not at any risk that the lender will demand immediate repayment before maturity. It means that First Bank will provide the 500 million to XYZ PSC for 5 years. And we don't expect First Bank to demand immediate repayment until 5 years' time. That is committed funds. Uncommitted funds. Some debt finance is not committed. It's uncommitted. Some debt finance is uncommitted. This implies that the lender is not obligated. The lender is not obligated to provide the finance to you. The lender is not under any obligation to provide the finance for you. Having provided the finance, the lender reserves the right to call in the finance at any time. Having provided the finance, the lender reserves the right to call in the finance at any time. A good example of uncommitted funds is bank overdraft. If a bank grants you overdraft, the bank is doing you a favor. And the bank can decide to take the overdraft back at any time. All right. We are done with the explanation on debt financing generally. Any question, please? Is there any question? All right. Please allow me just 2 minutes. I'll be back. Or 1 minute. If there's no question, let us look at equity finance. Equity finance success. We explained that equity finance is the finance provided by the owners of the business. And the owners of the business are the shareholders. Therefore, any money coming to the business from the shareholders will be categorized as equity financing. Under equity financing, we have different methods. One is retained earnings. Retained earnings. Retained earnings can be used as a source of finance. Retained earnings can be used as an equity source of finance. What is retained earnings? What is retained earnings? Retained earnings is that part of company's profits. Is that proportion of the company's profits that is not distributed to shareholders in the form of dividends. Retained earnings is that percentage of the company's profits or that portion of the company's profits that is not distributed as a dividend to shareholders. The earnings is retained and reinvested in the business. Therefore, where there is retained earnings as a source of finance, there are several benefits with retained earnings as a source of financing. The finance is readily available. The money is already available. The directors do not require the approval of the shareholders in order to utilize retained earnings to finance the business. There's no cost involved because the money is readily what's available. We don't incur any cost to use retained earnings. So please note, retained earnings can be adopted as source of financing. But for you to talk of retained earnings, the company must be profitable. You can only talk of retained earnings if you are making profits. Where a company is not making profit, how will you talk of retained earnings? So if you are not making profit, that's a limitation. Number 2 limitation. Retained earnings must be used efficiently. Retained earnings must be used efficiently to provide suitable returns on investment. Retained earnings must be used efficiently by the company to provide satisfactory return on investment. Otherwise, shareholders will demand higher dividend payments. What we are saying is, if you are retaining earnings, money meant for shareholders, you are not giving them their money. You are retaining this money. That means if you retain our money, you must be able to look for investments. You must invest the money to generate sufficient return for us. The money belongs to the shareholders. If you look at it, if you prepare your income statement, you now have your profit after tax. That profit after tax belongs to the shareholders. Out of the profit after tax, directors will decide what percentage to pay as dividends. Let's assume the profit after tax is 100 million. Let us assume that the profit after tax is 100 million. Now the directors now decided to pay 50% as dividends. That means out of 100 million, 50 million will be paid as dividends. 50 million will be reinvested in the business. That 50 million represents retained earnings. If you are reinvesting our money, then the company's director must invest in a project that generates satisfactory return on investment. If there's no good investment, then you have to return the money back to the shareholders. Then the last point under retained earnings is that where there is a dividend policy, if you look at retained earnings, earnings can either be retained or paid out to shareholders as dividends. It is either the company is retaining money or paying out money as dividends. By retaining earnings, it means that the company is withholding dividends from shareholders. By retaining earnings, it means the company is withholding dividends from shareholders. A company might have a dividend policy. A company might have a dividend policy. and its shareholders might have expectation about future dividends. What future dividend ought to be. In that situation, dividend policy can serve as a bottleneck to retain earnings. In that situation, dividend policy can become a limitation or a barrier or a bottleneck to retain earnings. So please watch out. Those three things can affect retained earnings. Profitability levels, dividend policy, absence of viable projects can affect retained earnings. So you may be asked, what are the limitations to retain earnings as a source of financing? Assuming you are asked, explain to us limitations of retained earnings as a source of financing. One is the profitability level. We can only talk of retained earnings if the company is making profits. Two is availability of viable projects. Companies can only retain earnings and reinvest such earnings if there is viable investment opportunities. If there is no investment opportunity that are viable or that is viable, then you can't retain earnings. Number three is dividend policy could be a barrier to retain earnings, could limit the amount of earnings the company can retain. Please note that. Because like 40% or 45% of your question will be in written form. All right. Issue of new shares. Issue of new shares. Company can issue new equity to raise finance. Companies can issue new equities to raise finance, like what we have currently in the banking sector. We have GT Bank issuing new shares. We have Fidelity Bank issuing new shares. Public offer. We have Zenith Bank doing an hybrid of public offer and right issue. Under equity financing, companies can issue new shares to source finance. There are three ways company can issue new shares to source finance. There are three ways companies can issue new shares in order to source finance. One is what we call public offer. The first one is called public offer. We also call it offer for public subscription. A public offer is the issue of new shares to the general investing public. A public offer is the issue of new shares to the general investing public. This method can only be used by publicly quoted companies. Public offer can only be used by publicly quoted companies. And this method is usually used if a company is planning to raise substantial amount of money. If a company is planning to raise substantial amount of finance, because the associated issue costs are very high. When we say public offer, the company will announce to the general public. Like if you look at GT now, there's advertisements, announcement to the public. That is public offer. The public will be aware. There's going to be an announcement in the news, in the print media. Number two, we have private placing. We call it placing. This is private placing. This is the issue of new shares. This is the issue of new shares. So a relatively small number of selected investors. A private placing is the issue of new shares to a relatively small number of selected investors. In brackets, institutional investors. This method can be used by public company as well as private company. You can do private placing. When we say placing, you are not announcing to the general public. The new shares will be placed with issue house, the stockbroking firm. It is the stockbroking firm that will look for buyer without announcing in the public. The method is usually used if a company is planning to raise a small amount of finance. And the associated issue costs are relatively small. You cannot ask yourself, you can ask ourselves, why will a company prefer public offer to private placing? Or why will a company prefer private placing to public offer? If the amount involved is small, it's better to do placing. If the amount involved, if the amount the company is planning to raise is small, it is cheaper to use private placing. But there's a risk. Private placing could result in dilution in ownership and control. If you do private placing, one individual can buy the whole shares. And that can lead to dilution in ownership and control structure. There's a risk. The number 3 method is what we call rights issue. You know, we mentioned that there are 3 ways company can issue new shares in order to source finance. We have explained public issue, public offer, private placing. The number 3 is what we call rights issue. A rights issue is the issue of new shares to existing shareholders. A rights issue is the issue of new shares to existing shareholders, usually at a reduced price. Usually at a reduced price. Just 1 minute. Rights issue. This is the issue of new shares to existing shareholders, usually at a discounted price. The new shares will be issued in accordance with the number of shares currently held by the shareholders, in proportion to the number of shares currently held. For a company to talk of right issue, that company must have shares in existence. There must be shareholders in existence. It means that only publicly quoted company can do right issue. And can announce to the public. Although private company can also do right issue. You issue shares to your existing shareholders. That means you are intended to bring more money, but you cannot announce to the public. For a company to talk of right issue, that company must have shares in existence. And that means there must be shareholders in existence. So you can do right issue to raise more funds. This environment calculation we apply. This environment under equity financing. Calculation we apply. I think we miss out something here. Oh, excuse me, please. Something was missed out here. All right, still on right issue. Please note these 3 points. Still on right issue, please note these 3 points. The issue price is the price at which new shares, the new shares in a right issue are quoted or is quoted. The issue price is the price at which the new shares in the right issue are quoted. This issue price is usually at a reduced price. is usually at a reduced price to the current market price of the shares, to the current market price of the existing shares. That issue price is the price of the new shares in a right issue. And that price is usually at a discount. Please note that. Point number 2, theoretical ex-right price. Theoretical ex-right price. Just 1 minute. Just 1 minute. The information is very vital. I'm sure in the course of trying to edit, the information was lost out. Yeah. Okay, I need to bring this information back to my system. Okay. After the class, I might need to reshare this. This information is vital for this discussion. Okay. Yeah. I've added something to this. Look at the issue price. Let me expand this a bit. The share price of the new shares in the right issue. That is the issue price. Then I want to discuss theoretical ex-right price. The theoretical ex-right price. Please listen. When a company announces a right issue, the cost of the existing shares is known as cum right price. Look at this word, cum right price. When a company announces a right issue, the current market price of the existing shares is called cum right price. The theoretical strike price is what the share price ought to be in theory after the completion of the right issue. The theoretical strike price is what the share price ought to be in theory after the completion of the right issue. Our theoretical strike price is the estimated share price. Our theoretical strike price is the estimated share price after the completion of the right issue. The theoretical strike price is calculated as the weighted average price of the existing shares, cum rights, and the issue price of the new shares in the right issue. You are going to get it, don't worry. Our theoretical strike price is the weighted average price of the existing shares cum right price and the issue price of the new shares. If you want to calculate theoretical strike price, you require 4 variables: existing shares, the price per existing shares, the current market price per existing shares, new shares, and the price per new shares. Those 4 variables are required to compute theoretical strike price. Then lastly, okay, let me discuss this since it's here already. Yield adjusted theoretical strike price. We call it yield adjusted theoretical strike price. Normally, it is assumed that when a company embarks on right issue, the money generated from it, the money generated we earn a return equal to the existing funds. I'll take that again. The assumption with right issue is that the proceeds generated from the right issue, we earn a return at the same rate as the existing funds. But where the new money raised is likely to earn a return different from the existing funds, different from the return of the existing funds. In that case, we are going to calculate yield adjusted theoretical strike price. What that concept is saying is, if you are raising new finance through right issue, and that money you are trying to raise will generate higher returns than the return you are achieving before, then you need to calculate yield adjusted theoretical strike price. Although it has not been tested, though, it's not. I think it's common in CR. All right, the last aspect, shareholders' choices. Please, when it comes to right issue of new shares to existing shareholder, it is not a must that the shareholder must accept the new shares. It's a right, not an obligation. What are the options open to shareholder in a right issue? There are 4 options open to the shareholders. There are 4 options open to the shareholders when you get to right issue. 1, the shareholder can take up their rights and buy the new shares, subscribe for the new shares. The shareholders can take up their rights and subscribe for the new share. That is option 1. Option 2, the shareholders can renounce the rights and sell the rights to the stock markets. The shareholders can renounce the rights and sell these rights to the stock market. By selling the rights, the shareholder is selling to another investor the right to subscribe for the new shares as the issue price. By selling the rights, the shareholder is selling to another investor the rights to subscribe for the new shares at the issue price. You can sell your rights. Number 3, the shareholder can take up some of the rights and sell some of the rights. Then number 4, the shareholder can do nothing. The shareholder can decide to ignore the rights. The shareholder can decide to ignore the rights and take no action. Please note, the shareholder will suffer reduction in investment value or loss in investment value if he or she decides to ignore the rights and take no action. Please note, the shareholder will suffer reduction in investment value if he or she decides to ignore the rights and take no action. All right. Wow. We are done with the explanation. Any question, please? It's a whole lot. Any question, please? All right, let's see. We have like 50 minutes.
Hello, sir.
Yes, somebody is speaking. I can't hear you very well.
All right, it's Jacob speaking.
Okay, Jacob.
Yeah, I wanted to ask about the Islamic finance sources. Has it been tested before?
Yes, it was tested before.
Okay, all right.
It's part of your syllabus.
Okay.
Was tested, I think, 2016. We shall discuss it also, but not tonight. I've been speaking for 1.5 hours. This one cannot be tonight. So. Let us start with this. Okay, let's look at it. Let's start with this small one first. Let us look at question 3 first. Let's start with a small question first. Although it's also I can question, no, whether small or big. All these questions are coming from ICANN. Who will read for us, please? Let me rest more. Any volunteer? Question 3.
Balama PLC, that's Balama, is a leased manufacturer of dairy products. In recent years, the company has experienced only a modest level of growth, but following the recent retirement of the chief executive, his replacement is keen to expand Balama's operations. The board of directors has recently agreed to support a proposal by the new chief executive that the company purchase a new manufacturing equipment to enable it to expand its range of dairy products. The new equipment will cost 50 million naira, and the company is seeking to raise a new finance to fund the expenditure in full. However, the board of directors is undecided as to how the new finance will be raised. The board is considering either a 1-for-5 rights issue at the price of 2.50 naira per share or a convertible loan of 50 million naira. The loan will be secured against the company's freehold land and building. The company's share is currently quoted at the price of 3 naira per share. So loans be explain how the theoretical X price of 2.92 is calculated and why the actual price might be different. Show your workings. C, prepare a report for the board members that fully evaluates the two potential methods of financing the company's expansion plan.
All right, thank you, sir. If you look at it back there, that is 20 marks question. The first requirement says, explain the terms rights issue and convertible loan. 3 marks. Please, who is explaining to us? What is right issue? What is convertible loan? Yes, please explain it.
I've explained rights issue.
Yeah, please go ahead.
Hello? I don't know if you can hear me. Hello?
We can hear
Yeah,
you,
I
so
can
you should go ahead.
now.
Oh, okay. So rights issues are shares given to existing shareholders at a price below the market value.
Okay. Okay. Is that all? At least rights issue of new shares for cash to existing shareholder at a price below the market price. Okay. Convertible loan. We need to get 3 marks out of here.
Okay, so a convertible loan is a long-term debt instrument that allows the holder the right, but not the obligation, to convert the debts into ordinary shares within a specified period. So once the debt is converted, the borrower will not repay the principal amount.
Thank you. We are done with A. The B part. Explain how the theoretical expiry price of 2 naira 92 kobo is calculated and why the actual price might be different. Show your workings. Before we go to this calculation and workings, first is the examiner has calculated theoretical expiry price for us, and the figure is 2.92. Now we need to explain how this is calculated, and we are going to explain via calculation. Now the question is, what is theoretical expiry price? Theoretical expiry price is the estimated share price after the completion of the right issue. Theoretical right price is the estimated share price after the completion of the right issue. It is calculated as the weighted average price of the existing shares, cum right price, and the issue price of the new shares. We can move to the whiteboard to explain how this is calculated. We can move to the whiteboard to explain how this is calculated. Please confirm you can see my whiteboard being shared now.
Yes, we can see.
Hello? Yes, you can see my whiteboard, right?
Yes, sir. Yes.
All right. We now come here, the B part. We want to calculate theoretical. We want to prove that theoretical X price in brackets T E R P. I will open my schedule. I have item, I have quantity, I have price per unit, then I have value. I will start with existing share. I have existing share. I have new share. Let's go back to the question quickly. Now look at the arrangements. The board of directors is undecided on how the new finance will be raised. The board is considering either a 1-for-5 rights issue. I'll come back at a price of $250 per share. Okay, I can come back here. The arrangement is, look at this, right issue arrangements. $1 for 5. If you want to interpret this, it means for 5 existing shares, issue 1 new share as right. That means I will come here. How many existing shares do we have here? 5. Can we see it? 5. New share. How many? 1. Pick it. Go back to the question. What is the current market price of existing shares? Look at it. The company share is currently quoted at a price of how much? 3 naira. You pick that. Current market price of existing share, 3 naira. What is the price per new share? Look at it. 1-for-5 right issue at a price of what? 2 naira 50 kobo per share. Price per new share 250. You pick that also. Now get your value. 5 multiplied by 3. This is 15 naira. 1 multiplied by 250. 2 naira 50 kobo. This is 2 naira 50 kobo. Now get total value. 17 naira 50 kobo. Get total quantity. 6. Your theoretical X right price is equal to total value divided by total quantity. This is equal to, 17 naira 50 kobo divided by 6. That will give you 2 naira 92 kobo. We have shown how the theoretical expired price was calculated. Any question, please? We have shown how the theoretical expired price of 2 naira 92 kobo was calculated. The next is why the actual price might be different from the theoretical extract price. Why would the actual price be different? Let us look at this. Oh, excuse me, please. The actual price or the actual market value of the shares may be different from the theoretical price for the following reasons. One, the existence of specific information, positive or negative, regarding the company or its market sector at the time of the issue. That can affect market price. When we say specific information, okay, we are aware that Zenith Bank is doing rights issue currently. Let us assume that for knowledge purposes, we got information that the chairman of Zenith is leaving. And the new chairman is going to be MC Oluomo. We got information that the new chairman of Zenith Bank is going to be MC Oluomo. How do you think market will respond to this information? Or we got information that the new chairman of Zenith Bank is going to be Asari Dokubo. How do you think the market will respond to this information? Yes. Definitely. The two personalities are not known to be banker. They are not even business. They are not even business people. Automatically, investor will move out of Zenith shares, and the actual price will fall. That is specific information, positive or negative. Automatically, investor will start dropping Zenith Bank shares, and that will affect the actual share price at the stock market. We are not saying this to disrepute those personalities, but we need it for knowledge purposes. Oluomo is into transport business. How on earth will he assume chairman of a bank without banking experience? Dokubo is known to be a pro-activist. What role will he play if he's now chairman of a bank? That information can affect share price. Number two, information regarding the use to which the proceeds will be put. Meaning that, what is the company planning to do with the money? You are trying to raise money. Company is trying to raise money through right issue. What is the purpose of this money? And the market reaction to this information. that can affect actual share price. Then number 3, the expectations of the investors and the stock market regarding the company's future. If the company's future is perceived to be favorable, investors will be willing to buy the company shares. If the company future is perceived to be favorable, investors will be willing to buy the company shares, and that will make the share price to rise. A company with a bleak future, investor will move away from the company shares. All right. We have answer A and B. Part A is for 3 marks. Part B is for 7 marks. So part B is for 4 marks. That means we have answered 7 marks. Look at the C part of the question. Prepare a report for the board members that fully evaluates the 2 potential methods of financing the company's expansion. 13 marks. You must do a report here evaluating the 2 potential methods. What are these methods? Right issue and convertible loan. It's an internal report to the board. You must tell us what is right issue. What are the benefits of financing our business with right issue? What are the risks of using right issue to finance the business? When you are done, we now move to convertible loan stock. You are going to tell us what is convertible loan stock. What are the benefits of convertible loan stock? Then what are the risks involved? Look at the report format and the report proper to the board of Balama PSC from Good Edge Financial Consultants. The dates, subject matter, financing expansion plans. We now start with right issues. Let us do this reading small. For an established listed company, Balama PSC is an established listed company. So the company can do right issue. For an established listed company, rights issues are more popular for the following reasons. One, rights issues are relatively cheap to make, perhaps less than public issue. Point number two, the issue price is relatively unimportant. Since all existing shareholders benefit from the reduced issue price or the cheap issue price in proportion to their shareholdings, there is no disproportionate gain. The reduced price is to all shareholders. The company needs to make this right issue price, the right price, significantly cheaper than the market price. This puts pressure on shareholders to take up their rights or sell to another investor. Thus, right issue tends not to fail. That is, right issue is usually always successful, or is always successful. You can either take up your right and subscribe for the shares. In this case, the company will get the money for you, or you can sell your right to another investor. In this case, the new investor will purchase the shares. The bottom line is the company has generated funds. With right issue, there is no dilution in ownership and control, provided the shareholder take up their rights. With right issue, there is no dilution in ownership and control, provided the shareholder takes up their rights. The discounted price ensure that the new shares are fully subscribed. And covers the possibility that the market price of the shares might fall. We are trying to talk about the advantages of the reduced price. The reduced price will make people to subscribe for the shares. It also provides covers for the possibility that the share price might fall after the completion of the right issue. And lastly, the use of right issue leaves the credit line free to finance further expansion. by using right issue. Your credit line is free to finance other expansion. And enables the non-current asset to be used for this purpose as security.
ADA. Ada.
Wait for him. We have tried to discuss merit of right issue. We now go to convertible loan. Convertible loan stock. Convertible loan stock or convertibles are a mixture of loan and equity financing. They are issued as loan stock with the right to convert them into equity shares of the same company at some predetermined dates. Now, what are the benefits of convertible loan stock? From the perspective of the investor, convertible loan stock are relatively safe. You can convert the debt to ordinary shares and become part of the owner in that company. From the perspective of the company, what are the benefits of convertible loan stock? One, cheap. It's a cheaper source of financing. Convertible loan stock is a cheaper source of finance. The loan stock is generally cheap to issue. Convertible loan stock is also cheap to service because the interest payable on convertible loan stock is allowable for tax purposes. Next, convertible loan stock are self-liquidating liability. Convertible loan stock are self-liquidating liability. What it means is that once the debt holder converts the debt to ordinary shares, then the company, the borrower, does not need to repay the loan. The liability is self-liquidating. Limitation of convertible loan stock. Of course, the company must provide security for the loan. there is the possibility that the lender may impose conditions or covenants and the last aspect, using convertible loan stock can increase the financial risk of the business.